let's move on because this is actually a very important part of the story as well. Let's put this up there on the screen, which is that Wall Street is being dragged down primarily by tech stocks. Now, I don't want to overstate this because all sectors of the economy are down, but the reason why tech stocks and the decline in them matter the most is because they make up such a large portion of the index funds, like the S&P 500. And so tech companies, despite the fact that they saw, sales go way up during the pandemic, and, if you think about indices like QQQ and others that aggregate just tech, they were doing phenomenally well for almost, for years and years and years. You basically couldn't lose money if you weren't investing in the big 5 tech companies. Well, the broader S&P 500 is now down by 3.2% for the new low of 2020, and it is primarily dragged down by technology. And so the decline in technology and the sector there, which again I was talking about, there's a bleed-in effect here from the private market. So you are seeing major technology companies like Facebook or Meta, Meta, Amazon, and others who are declining in both their hiring, in their terms of their price. Let's put this up there on the screen about Amazon in particular, which had its worst day since 2006 earlier, Krystal, where they dropped by 11% after posting a $3.8 billion loss in the first quarter. Now, look, Amazon is going to be fine. It's their stock is completely okay, but I don't think that people have really appreciated how much of Amazon and Facebook and technology was dragging the S&P 500 up during the pandemic in particular. And so, if you think about the set and forget, typical middle-class investor, 401k person, they're not picking individual stocks. They're almost entirely invested in like ETFs or Vanguard or whatever, Vanguard 100, the total market, etc. A lot of that, because just the sheer amount of wealth that's tied up in technology, means that when tech goes up, tech goes down, it's going to drop the whole market. And it will have a massive impact on middle-class portfolios. And I think that's the main story that I think we should focus on, which is technology was propping up all of these indices. It was propping up a lot of people's retirement portfolios, whether they knew it or not. Yeah. And so when you look at it and it's down by 15%, this is a major part of the reason why. So.
These stocks were some of the best performers during the pandemic, which makes perfect sense. People are stuck at home,
Zoom,
things like Peloton, things like Zoom, things like Netflix, things like Amazon performed extraordinarily well because you couldn't go out and do all the normal things that you do, and restaurants were closed and gyms were closed and all of that. But you could be at home, you could watch Netflix, you could do, if you're PMC, you could order your little Peloton bike and jump on board there. You could certainly order whatever you wanted off of Amazon. So those stocks performed extraordinarily well during the pandemic. And now we've seen Amazon, I think, is a really important one. I'm going to talk a little bit more about them in just a second. But you see them with, losing money, definitely not living up to their earnings expectations. You see them announcing a hiring slowdown, which is extraordinary and also very different from the dynamic in the pandemic. For years now, actually, the biggest problem for Amazon has been that they could not hire enough bodies because Amazon, as you guys know, if you watch this show, they basically treat their workers as disposable. They sort of intentionally burn through them on, they even have a time frame. They expect to burn through them in 3 years time frame. They never elevate them to management. And so their biggest issue was they're starting to say, we're kind of running out of workers that we can even employ in our warehouse fulfillment centers. And so now for them to say, they actually came out and said, the CFO said that they have too many workers after hiring so many during the COVID-19 pandemic. Now, I wouldn't expect layoffs, again, because they have such a churn and burn model. If they just let workers, if they just organically burn out workers the way they normally do, then they'll get down to the levels that they ultimately want. But that is a significant difference. Netflix also
got hammered.
Got hammered in there. What was it? For the first time, they were losing net subscribers, and they're starting to play with, maybe we got to go to an advertising-driven model. So these are all indications that those stocks and those companies that performed so well during the pandemic are facing a bit of a reckoning now. Part of why Amazon is so important, and you guys know we talk about Amazon a lot on this show, is because they really have their tentacles in almost every part of not only the national economy, but also the global economy. So they are very much impacted by consumer spending trends. They're very much impacted by supply chain issues. They're very much impacted, this is also a tech stock, and they're very much dependent on their cloud computing services, which, by the way, thank you, Joe Biden, Biden for awarding them another government contract in spite of their union busting. But that's why when you look at what's going on with Amazon, it's kind of a leading indicator of where all of these sectors ultimately might go, because yes, it's a tech stock, but they really have their hands in so many aspects of both our national and global economy. So I think that's why this is so extraordinarily significant that that they are nowhere near where they were during the pandemic.
Yeah, the tech stock phenomena is going to basically make it so that a lot of the investments, I actually just read a story this morning about the diamond hands generation. Shout out to my investors, people who are like my age, started trading. Guess what? Well, the diamond hands generation has now likely lost more than 100% of their gains during the meme stock era. This is a Bloomberg article that just came out. Look, you guys knew the risk, and let's all be honest about what exactly was happening there. Now, that being said, that just shows you about how dangerous this really can be in the, you have boom times, and then you also have the down times. And, if you actually did abide by diamond hands, then you probably lost a lot of money. And the reason why that this matters is that when amateur investors and stuff like this get burned, and you also have people, I was talking earlier, a much more traditional 401k investor significantly down. We saw the biggest crisis of confidence of our economy in our lifetime was 2008. I mean, I remember my dad and other people who wake up and you look at portfolios down by 50%. You're like, this is my life saving. This is my meal. This is it. College, house, future. People made whole plans and it just evaporates overnight. And a lot of people never came back from that. And people need to realize that we are probably, and this is kind of how I end my monologue, this is not going to end anytime soon. This is not, if anything, the COVID recession was a blip in terms of what we're headed for, because the fundamentals of our economy are not good. And everything is really expensive. So a decline in consumer cash, that means all across the board, plus technology. When you have a dry up of high interest rates, and you're not going to have cheap capital, which can at least finance some of the riskiest investments that are happening. So you have a decline in the public markets. The Journal had a piece on its front page yesterday, how to make money when stocks are down and bonds are not returning. So it's like, yeah, actually, how do you make money? And the basic advice is like, put it in a savings account. Hope for a 0.05 interest rate. Yeah, actually, it probably isn't even that high, but hope for a mediocre interest rate in order to keep pace with 9% inflation about what so no matter what, you're hosed. Like you're either down 8. Think about this. You're either down 8.5% if you put your money in savings relative to inflation, or you're down by like 20% if your stocks are down and you have to keep up with inflation. So no matter what, almost every sector of this economy, except for the top 0.01%, is basically hosed right now relative to the last 5 years, which is a really depressing story.
It is a depressing story, and especially if you think about what happened out of the Great Recession, because the big institutional players, they took a hit during the Great Recession, but they had the capital reserves to be able to buy distressed assets at the time.
And then the Fed was pumping in all that cheap cash.
That's right. Yeah. And then they made more money than ever off of those, distressed assets, in particular housing stock. So if you have the money and the capital to play the long game, there might be some bargain basement deals coming up in the market. But if you are a regular person and you've invested your life savings, your retirement, whatever it is, into the markets, and you don't have the bandwidth to hold on for a decade until things turn around,
exactly.
It's going to be very, very difficult and very ugly.
Absolutely.
Cable news is ripping us apart, dividing the country, making it impossible to function as a society, and making it impossible to know just what is true and what is false. But the good news is they are failing and they know it.
That is why we're building something new, a new mainstream, a healthier one, something more trustworthy, something that we are going to need in one of the most pivotal times in American history. We are building up here for the midterms, for the upcoming presidential election, but we need your help. So if you can help us out by becoming a premium member today at breakingpoints.com, we're trying to change America for the better and the entire world.
So what are you waiting for, guys? Go to breakingpoints.com and sign up and help us build a new mainstream.